frequently asked questions: hold, sell, or exchange? Business owners and taxpayers that own property, they really face three different options with that property. And what I want to do in this segment is briefly address those and kind of the pros and cons of the different approaches. First approach is to hold a property. And a buy and hold strategy with real estate is a very common approach. So somebody buys and holds for long-term investment. However, one thing I just want to point out is that some taxpayers, if they're in a part of the marketplace where there's not a lot of economic growth, not a lot of job creation, not a lot of appreciation or increasing rents, there might be a significant opportunity cost to hold long-term because they may have the potential to exchange out of that asset in a part of the economy where things are fairly flat or maybe even going downhill and exchange that property for a location and an economy where there's a lot of job growth and a lot of economic activity and where projections show significant increases in property values and significant increases in rental income. So that might be a reason why people might want to consider exchanging, even if their initial approach was to hold long term. The second strategy is to sell property and sell this in a taxable sale. So this would be a situation where a taxpayer doesn't want to own real estate any longer. And in this situation, they're going to sell that property and pay all of the taxes that are owed. So they would pay the depreciation recapture at 25%, the federal capital gain taxes at either 15 or 20%, the net investment income tax at 3.8% if it was applicable to them, and then finally the appropriate state tax if it was applicable. The big challenge with this strategy from a return on investment standpoint is that it's very difficult to take the after tax, that net equity, and redeploy that into an investment outside of real estate and get the same return on investment, the same ROI with after-tax dollars as you can by keeping that money redeployed into another investment property using all of the gross equity, which is what's done in a 1031 exchange. So from a return on investment standpoint, it could be challenging to try and get the same return on investment. At the same time, there's some investors that do want to liquidate and do want to sell the property. And so when they sell, keep in mind that an exchange is tax deferral, and that capital gain tax liability will be paid down the road when the property is sold for cash in a taxable sale. Finally, some taxpayers may want to do a 1031 exchange, and they can do a fully deferred exchange. So this would be a situation where they defer all of the taxes in a fully deferred exchange, or some investors do opt for what's called a partially deferred exchange. And in this scenario, they receive some boot. So they maybe receive some cash from the sale. Maybe they reduce their mortgage liabilities because they want less leverage. But keep in mind, a 1031 exchange is not an all or nothing proposition. You can obtain full tax deferral if that's what your objective is, but many taxpayers proceed with a partially deferred exchange. So they exchange one property for one more better replacement property that's going to perform better, and they receive some taxable boot and pay taxes on those proceeds or in that reduction in mortgage liabilities. To review your specific 1031 exchange situation, contact Asset Preservation's headquarters in California at 800-282-1031 or our Eastern Regional Office in New York at 866-394-1031. Please read the full disclaimer, as Asset Preservation cannot provide tax or legal advice.